Hello. Welcome to our next chapter, that is your IND AS 23, which is borrowing cost. So borrowing cost, very small IND AS. Basically, it helps you allocate your interest cost, any of your borrowing cost, whether it has to be allocated to the asset or it has to be expensed out. This entire IND AS is only for this, and if it has to be allocated, then how much and till what time. So this is what the IND AS talks about. So it helps allocate, that is your capitalize borrowing cost to qualifying asset. So we have to understand two parts, that is what is your qualifying asset and what is your capitalization. So what is your qualifying asset? That is your QA. What is your qualifying asset? So your qualifying asset is an asset that takes a substantial period to get ready for its intended use or sale. That means it takes a substantial period. What is a substantial period? It has not been defined. Is it 12 months? No, there is nothing been defined. You have to use your own judgment whether it is a substantial period or not. So say for example, your manufacturing plants, power generation facilities, investment properties, usually all of these take substantial period of time to make. Understood? Okay. So then there are your two types of borrowing cost. First is your specific borrowing and second is your general borrowing. So what is the difference between specific borrowing and general borrowing? Say for example, you've taken money from your parents and you've told them, ki, I need I need 200 rupees. I need 200 rupees these to buy these FR notes. Because you have mentioned that I need this 200, I need this 199 rupees to buy these particular Drona chartered FR notes. This is a specific borrowing because you've told them that you're going to use this money for this purpose. That is a specific borrowing. But if you just tell them, ki, Pa, I need 500 rupees, and you don't tell them what you are going to use them for, you just told them, ki, Pa, I will be needing 500 rupees. That is a general borrowing. So your specific borrowings are funds borrowed specifically for the purpose of obtaining your qualifying asset. It is specifically obtained for the purpose of obtaining your qualifying asset. So capitalization, what will be your capitalization? Your capitalization will be your actual borrowing cost, whatever is your actual interest that you're paying, actual borrowing cost minus investment income on temporary investment of funds. Say for example, in this case, you borrowed 100 crore rupees to make a building, but your building will not be made immediately, right? So what do? You park this 100 crores in a FD till the time your building is made, and you keep breaking it into parts. Ki, abhi you took 20, then you took 30, then end you took 50. So in such a case, you will be earning interest income on the part that is still invested. So therefore, that has to be subtracted. That is, investment income on temporary investment of funds has to be subtracted. Okay, so this was your specific borrowing. Second comes your general borrowing. General borrowings are all borrowings that are not specific, are general. Your qualifying asset is funded from a pool of borrowing. There might be multiple borrowings out of which your qualified asset is funded. Capitalization will be your total general borrowing cost, because you might be having loan 1, loan 2, loan 3, all with different interest rate, different amount. So what do? You calculate ki, acha, what is my total borrowing cost of all these three? Okay. So this will be your total borrowing cost, and divide by your total general borrowings. That means this is your total interest, upon this will be your total principal, into how much expense did you do on your qualifying asset. So this will be your expense into on qualifying asset. So basically you're finding out that basically what is my average rate of interest, what is my average rate of interest for all of these general borrowing, and then you multiply it by your how much expense you've done, so that it is easier to allocate all the group borrowings together at one blanket rate. Great. Okay. Now next part is, okay, capitalization. When do I start? When do I pause? And when do I stop? Okay. So your capitalization will start. Your capitalization will start when all of these conditions are satisfied. That is, all 1, 2, and 3. All three of these have to be satisfied. So your expenditure on qualifying assets should have been occurred only. Then of course you will be allowed to start. Your borrowing cost has been incurred. That means the interest you are paying. Say for example, if it is an interest-free loan, then what will you capitalize? Nothing. Next are activities necessary to prepare QA or qualifying asset for intended use have been undertaken. That means the activities have already been started. Only when all these three have been satisfied, only then can you start. Okay, when will I have to pause? When will I have to pause capitalizing my borrowing cost? Okay, we are doing capitalization when do I have to pause capitalizing by borrowing cost? You will suspend if during the extended period, if active development is not taking place. Say for example, because of some reason your development has stopped. If your development of the qualifying asset has stopped, you also pause the capitalization. Okay. And next is cease, when you will stop when substantially all activities necessary to prepare the qualifying asset for its intended use, also includes sale. If these activities are completed, that is when the capitalization stops. Great. Now coming to your last part, that is your exchange difference. So if because of exchange difference, if there is any gain, there will be no treatment in capitalization. If there is any gain, there will be no treatment in capitalization. However, if there is a loss, in such a case, your borrowing cost will be lower of your exchange loss, whatever loss you have incurred because of the exchange rate fluctuation, or your BC in functional currency, that is your borrowing cost. Your borrowing cost in functional currency minus actual borrowing cost in foreign currency. So borrowing cost in functional currency minus actual borrowing cost in foreign currency, whichever is you subtract this and then you do whichever is lower, that will be your borrowing cost. Okay, BC stands for borrowing cost. Then there are certain miscellaneous items. Dividends payable on shares used for financing purpose meets the definition of borrowing cost. So what you have to understand, borrowing cost does not only include interest, it also includes dividend. When asset is developed by one group company but financed by another group company, such cost will be capitalized in the group financial statement. Say for example, the asset is being made by the holding company, or say for example, the asset is being made by the subsidiary company, but it is financed by the holding company. That means the holding company is paying the money. In such a case, who capitalizes the interest? Does the holding company because they are providing the finance, or does the subsidiary company because it is their qualifying asset? So in such a case, when it is developed by one group company but financed by another group company, such cost will be capitalized in the group financial statement. So when we make the group financial statements, it will be capitalized in those balance sheet. Capitalization shall be ceased. Capitalization will be ceased. That means stop when inventories stop maturing. That is no value addition with passage of time. If there is no value addition with passage of time, why this is involved? Because say for example, when you are making wine, when you are making any alcohol, so these are better the longer they are kept in storage. So there is value addition when you are storing them. Therefore, borrowing cost will be capitalized. However, once they stop maturing, that means there is no addition. That is when your borrowing cost capitalization stops. And with this, we are done with this IND AS, and I will see you in the next one.